At exactly 9:12 a.m. or a quiet Tuesday morning, David signed what he believed was one of the most important and intelligent financial decisions of his life. A 30-year mortgage at a rate he had fought hard to negotiate down. Watching numbers move on a screen, hearing the loan officer adjust terms, feeling a quiet surge of control every time the rate dropped even slightly, and when the final number landed at 6.10%, he leaned back in his chair with the kind of satisfaction that comes from thinking you've just outplayed a system that most people don't even understand. The loan officer smiled, told him he had done well, reassured him that he was getting a competitive deal, and David walked out of the office carrying a folder of documents and the belief that he had just secured his financial future in a smart and disciplined way. But what he didn't realize, what almost no borrower ever fully sees, is that the mortgage he had just signed wasn't a single transaction. It wasn't even a simple agreement between borrower and lender. It was a layered financial structure designed to generate profit in multiple directions at once, some visible, most invisible. And while David was focused on the number that felt most important, the interest rate, the lender had already positioned itself to earn money from his loan in ways that would never appear clearly in a single place, ways that would unfold over time, quietly, predictably, and completely within the rules. Because the system isn't built on tricking you in obvious ways. It's built on guiding your attention toward what feels important while everything else operates just outside your awareness. And just a weeks before David sat in that same chair, another borrower had gone through the exact same process with the exact same lender. Her name was Sophia. Her loan looked almost identical on paper. Similar amount, similar timeline, similar structure. But over the life of her loan, she would end up paying significantly more than David. Not because she made a mistake that anyone could easily point out. Not because her credit was worse. Not because the market shifted dramatically in those 2 weeks. But because she didn't recognize the layers built into the mortgage. She accepted what was presented as standard. She didn't question the smaller numbers. And she didn't realize that every component of the loan, from the rate to the fees to the services bundled inside, was part of a broader system of negotiable profit channels. And that's where the story really begins, because the first layer of that system hides in plain sight inside the interest rate itself. When a lender quotes you a rate like 6.10%, it feels like a number that comes directly from the market, something fixed, something external, something beyond negotiation except at the margins. But in reality, lenders often access money at a lower wholesale rate, let's say 5.75%, and then add a margin before presenting it to you. That margin doesn't show up as a fee. It isn't labeled as profit. It becomes embedded in the structure of your payments over time, turning into what looks like a normal cost of borrowing, but is actually a revenue stream created through positioning. And because that difference is small in percentage terms, it doesn't feel significant in the moment. But over the course of 30 years, it compounds into a massive number, quietly transferring wealth from borrower to lender in a way that never triggers immediate resistance. And what makes this layer so effective is that most borrowers never ask for the baseline, the so-called par rate, the rate without added margin, meaning they never even see the starting point from which their offered rate was built. And as soon as that first layer locks in, the rest of the structure begins to stack, because the second layer enters disguised as an opportunity, something framed as a benefit, discount points, the idea that you can pay money up front to reduce your interest rate, which sounds logical, almost strategic, like you're taking control of your financial future by making a calculated trade-off. But what most borrowers don't fully calculate is the break-even point, the amount of time it takes for the monthly savings from the lower rate to recover the upfront cost. And in theory, if you stay in the loan long enough, the math can work, but in reality, life rarely follows that timeline. People move, refinance, upgrade, relocate, or change financial strategies, and many borrowers exit their mortgage long before they reach that break-even point, meaning the lender collects immediate cash from the discount points while the borrower never fully realizes the long-term savings they paid for, turning what felt like a smart optimization into a front-loaded profit mechanism. And then comes the third layer, the origination fee, one of the most normalized charges in the entire process, presented as the cost of creating the loan, something that feels official and therefore unquestionable. Borrowers expect it, accept it, and move forward without negotiation. But when you break down the actual work involved in originating a loan, the data entry, the document collection, the coordination, it often costs significantly less than what is charged, and the difference becomes margin, clean, simple, and widely accepted because it is framed as standard. And by the time you reach this point in the process, something subtle has already happened. Your attention has been anchored to the rate and the monthly payment. Those are the numbers that feel real, the ones that connect directly to your financial comfort, and everything else begins to fade into the background, which is exactly where the system becomes most effective, because the fourth layer begins to operate through timing, specifically through rate locks. You are told that your rate is secured for a certain period, 30, 45, or 60 days, giving you a sense of stability in a changing market. But that lock comes with conditions. If the closing is delayed for any reason, paperwork issues, scheduling conflicts, internal processing delays, you may be charged an extension fee. A few $100s here or there, not enough to derail the deal, but enough to add another stream of revenue. And because you are already emotionally invested in the property, already imagining your future in that home, these fees are rarely challenged. They are accepted as part of the process, even though the structure itself often shifts risk away from the lender and onto you. And then the fifth and sixth layers appear, small individually but powerful together. Processing and underwriting fees, justified as necessary steps to review your application, verify your income, and assess your financial profile. And while those steps are real, the cost associated with them has been significantly reduced over time due to automation and technology, yet the fees remain relatively high, fragmented into separate line items that feel manageable on their own, but collectively form another substantial portion of the lender's profit. And what makes these layers so effective is not just their existence but their presentation. They are broken down, labeled, and normalized in a way that discourages scrutiny. And by the time David reached the final stages of his loan, he had already passed through 6 different profit layers without ever feeling like he was losing control, without ever feeling like he was overpaying. Because the system isn't designed to feel aggressive, it's designed to feel smooth, predictable, and professional, guiding you step by step while quietly optimizing every part of the transaction in the lender's favor. And the most important realization at this stage is not that these layers exist, but that they are rarely negotiated as a whole. Borrowers focus on one number, one outcome, one moment of perceived victory, while the real negotiation happens across multiple dimensions simultaneously. And until you see the full structure, you don't even realize what you're negotiating against. You think you're choosing a rate, but in reality, you're stepping into a system that has already been calibrated to extract value in ways that don't require your awareness to function. By the time David reached closing, he believed the hardest part of the process was over. The rate was locked, the documents were prepared, the numbers looked familiar, and all that remained was to sign, transfer funds, and move forward into what felt like a stable, predictable financial commitment. But what he didn't realize is that the most powerful profit layers in his mortgage had not yet fully revealed themselves, because everything up to this point had been about setting the foundation, building the structure, and anchoring his attention to the visible elements of the deal, while the deeper layers, the ones that generate the largest profits, operate after the loan is created, beyond the moment where most borrowers stop paying attention. And the first of these deeper layers appears almost immediately after closing, though David would never see it directly. Within weeks, sometimes even days, his loan would be sold on the secondary market, not because there was anything unusual about it, but because this is how the mortgage system is designed to function at scale. Lenders originate loans not just to collect payments over time, but to package and sell those loans to larger financial institutions, government-sponsored entities, or private investors. And when that sale happens, it doesn't occur at the exact value of the loan. It often happens at a premium, meaning the buyer is willing to pay more than the original loan amount because of the expected stream of future payments. And that difference between the loan's face value and its sale price becomes immediate profit for the lender, often referred to as gain on sale. And on a typical loan, this can represent thousands of dollars earned in a single transaction that the borrower never sees, never negotiates, and never fully understands. Because from David's perspective, nothing has changed except perhaps the name of the company he sends his monthly payments to. But behind the scenes, his mortgage has already been transformed into a tradable financial asset. And that leads directly into the next layer, mortgage servicing rights, which represent the right to collect payments, manage the account, and interact with the borrower over the life of the loan. And this right itself has value. It can be retained by the original lender or sold separately to another company, creating yet another stream of profit. Because servicing generates ongoing income through fees, account management, and the operational handling of the loan. And in some cases, these servicing rights are bundled, traded, and valued as standalone assets, completely detached from the borrower's understanding of the process. And then comes one of the quietest but most consistent layers, the escrow float, which begins the moment David's escrow account is funded. Throughout the year, a portion of his monthly payment is allocated toward property taxes and insurance, accumulating in an account that may hold several months' worth of funds at any given time. And while that money sits there, waiting to be paid out when bills are due, it doesn't remain idle in a broader financial sense. It contributes to the institution's overall liquidity, potentially generating interest or supporting other financial activities. And yet David receives no direct benefit from that usage. He simply fulfills the requirement of maintaining the account, unaware that even his reserved funds are part of a larger financial system. And by the time all 12 layers are considered together, from the rate markup to the upfront fees to the post-closing asset sales and ongoing servicing income, the mortgage reveals itself not as a single agreement but as a multi-channel profit engine, carefully structured to generate revenue at every stage of its life cycle. And this is where the psychological dimension becomes even more important, because the system doesn't rely on borrowers being uninformed. It relies on them being focused on the home, the monthly payment, the emotional significance of ownership, and that focus naturally narrows attention, making it easier for the surrounding layers to operate without resistance. And this is exactly what happened with another borrower, someone like Sophia, who entered the process with confidence, perhaps even with more financial strength than David, but signaled something subtle to the lender. She mentioned a large down payment early in the conversation, expressed commitment to a specific property, and showed less interest in comparing multiple offers. And those signals, while seemingly harmless, changed the dynamics of the negotiation. Because lenders don't just evaluate risk, they interpret behavior. They assess how likely a borrower is to question fees, to walk away, to challenge the structure of the deal. And when a borrower appears committed, confident, and less price sensitive, the incentive to reduce margins decreases, not out of malice, but out of optimization. The system adjusts based on perceived leverage, and that's why two borrowers with similar profiles can end up with significantly different outcomes, because the negotiation isn't just about numbers, it's about perception, timing, and strategy. And this is where the narrative begins to shift from awareness to action, because once you understand how these layers operate, you can begin to approach the process differently, not by trying to fight the system in a confrontational way, but by navigating it with clarity and intention. The first step is to expand your focus beyond the interest rate, to recognize that the rate is only one component of a much larger structure, and that every fee, every service, every condition attached to the loan represents a potential point of negotiation. The second step is to create comparison, to obtain loan estimates from multiple lenders, before revealing details that might reduce your leverage, such as urgency or emotional attachment to a specific property, because comparison introduces competition, and competition naturally compresses margins. The third step is to ask direct questions about the baseline, to request the rates without added markup, to understand where the numbers begin before they are adjusted. The fourth step is to examine the fee stack, not as a collection of fixed costs, but as a flexible set of charges that can be reduced, removed, or offset through negotiation. The fifth step is to separate bundled services, such as title insurance, and explore independent options that may offer better pricing. And the sixth step is to slow down at the most critical moment, to review the final closing disclosure line by line, comparing it to the original estimate, identifying changes, questioning discrepancies, and ensuring that the deal you are signing matches the one you were promised. Because the final stage is where small adjustments can still be made, where awareness translates directly into savings. And the most important realization in all of this is that the system itself is not broken. It is simply optimized for those who understand it, and neutral for those who don't. And the difference between David and someone like Sophia is not intelligence, not discipline, not even effort. It is visibility, the ability to see the full structure of the mortgage, rather than just the surface. And once that visibility exists, the entire experience changes. The conversation with the lender becomes more precise, the questions become more targeted, the decisions become more intentional, and the outcome becomes something you actively shape rather than passively accept. Because in the end, the mortgage is not just about borrowing money. It is about navigating a system of layered incentives, and the moment you understand those layers, you stop being a participant in someone else's optimization and start becoming the one who controls the deal. And that is the difference between signing a mortgage and actually mastering it.